Hello, and welcome to the latest edition of Citrus Bites from our offices in Sevenoaks. So, normally when I speak to you, there's a particular story that we home in on, and this has ranged from the Chinese economy to special tariff day. I think it was Independence Day. We've talked about wars, we've talked about the UK economy, but very rarely do all of these subjects kind of come together at the same time to give us a really interesting set of dynamics to try and work out actually what's the most important thing to talk about. And it feels like there's quite a lot of important things right now. So I'm going to narrow that down quite a lot for today and just talk about a couple of key things that are going on within the economy. I thought I'd start with the Bank of England base rate. So, bit of a flavour for where this is going. We've now been at 3.75 since December, and the most recent Monetary Policy Committee meeting, which I think was the 30th of April, voted 8-1 in favour of leaving rates at 3.75%. So that's the bank base rate. Now, interesting, it was 8-1. You go, well, how come there was a slight difference with the one? Well, the one committee member voted for a 25 basis point increase in the bank base rate back to 4%. So I suppose it becomes, well, why was there that slight difference of 8-1? So really, we come back to looking at inflation. So I remember typically talk about three things. The first thing I talk about is inflation, where we look at core inflation and CPI inflation. So CPI, most recently in the 12 months to the end of March, came out at 3.3%, which was actually up slightly. And it's been a little while since we spoke about inflation, but frankly, having gone through 2025, actually forecasters were expecting inflation to start heading really back towards the Bank of England target of 2%. So why have we seen that increase? And that increase in the 12-month rolling to 3.3, actually, you know what? For most of us, we're feeling this. So for those of you going shopping and going, wow, doesn't it feel like food has suddenly got really expensive over the last few years? Well, you'd be right. So this is, yeah, I think sort of meat alternative is actually the one with the highest uplift over the last, I think, 5 years, where it's gone up by over 100%. So the price of sort of vegetarian slash meat alternative up by 100% in the last 5 years. And then other items, so things like chocolate, butter, eggs, we're talking about over 50% increases. So we're really feeling now this inflationary pressure. And typically, when inflationary pressure's in there, obviously interest rates is one of those levers that the Monetary Policy Committee can pull to try and take the heat slightly out of these price increases. So they raise interest rates. So obviously that recent meeting, one member said, actually, I don't like the way inflation's going. Inflation's going in the wrong direction. It was supposed to be heading to the 2% target. We need to take action. So the question is, why are we seeing this pressure? And I think there's a couple of areas I just want to home in on for today. So actually, when we typically look at the average weekly earnings is something we've looked at, and unemployment is something we've regularly looked at. Unemployment is actually quite steady. So that's that sort of holding firm. It's been increasing gradually up to about 5%, but it dips slightly in the most recent stats. So it's not unemployment and average weekly earnings going back kind of 12, 18 months. That pressure on weekly earnings because of the shortage in the labor force, that's easing, and that's been easing for the last few months. So that heat came out. And yet it's been replaced with a couple of things. So the first thing I want to talk about today is what's going on with oil prices, Strait of Hormuz. Now, this is probably something you've heard about a lot. I actually spoke about it. I can't remember how long ago it was where I started talking about oil. Maybe it was about 18 months ago. This waterway is one of the most important waterways in the world. Very small waterway, small passage, Iran to the north and the UAE and Oman to the south. But actually, interesting statistics here. So you look at the size and the volume of vessels carrying oil and LNG, typically, that go through this strait. And any disruption to this strait, as we now know, has a huge impact on oil prices. So I think the Iran war started go back end of February. So remember, those inflation stats I just showed you, really, there's very early days in the pricing pressure coming through. But what's basically happened is 20% of the world's oil supply has basically been removed from that supply. That has different impacts on different countries. So, for example, Asia is a real importer of oil. They're feeling this. This price increase in oil is having a notable impact. So when we look at it, Brent crude live is one of those oil statistics that gets talked about. There's a few different types of oil I've talked about before. There's West Texan, there's Brent. So I talk about Brent. So we can see here towards the right hand side what's gone on with the price of oil because the supply disruption has now kicked in. Is we're seeing barrels of oil now going to upwards of over $100 a barrel towards $120 a barrel. The last time this was experienced was actually the breakout of Russia-Ukraine war. So that caused a spike, as you can see, in 2022. We're seeing another spike for the Iran war come 2026. Now, clearly there is a global oil price. So actually, for most, even if you can get hold of the supply, the oil price is the oil price. From a UK perspective, we are a net importer. So we need to rely on oil from elsewhere. Where do we typically get that from? Well, we get it from a couple of places. We get some from America. We get a fair amount from Norway. Frustratingly, you've probably heard this talked about. A lot of the production made by Norway comes from the North Sea. Where does the UK produce oil? The North Sea. So yes, oil produced in the North Sea from the Norwegian part of the North Sea gets pumped to Norway, back to the UK. So there we are. It's one of those supply conversations that I know is kind of government discussing right now. Is it a good thing to do, a bad thing to do? Lots of issues around kind of energy and green energy and what's most important and protecting the supply and that kind of conversation. But this has caused a really extreme spike in the oil price. What happens when we see that spike in oil price to over $100 a barrel? We obviously then start to see things at the pump. So for those of you that don't have an electric vehicle, we're still using diesel or unleaded. You can see, particularly if you're a diesel driver, diesel prices up by around 30% compared to where we were kind of end of February, and unleaded up by about 20%. So just turning this back slightly to go, well, that's all very well, Richard, but talk to me about food prices. One of the big dilemmas, of course, is we've got things playing out in the world that are impacting crops already, such as climate change, for example. So we know that's impacting crops. But actually now the movement of food, for example, where food's being imported, all of that is coming at a higher price because oil price is going up. It costs more to transport it. When things cost more to transport, typically that means companies try and work out, well, how do we cover the cost here? Even if we can get hold of the oil, how do we cover the cost? The fact it's costing more to move items around. Those prices are very often passed on to the consumer. And the consumer, therefore, is facing these increased prices. That's leading to inflation. And hence we get that challenge over interest rate pressure. So the war in Iran, clearly, everyone's waiting to see, well, what happens next? What is going to be the outcome? How quickly can we get oil prices starting to come back down again? Lots of different views over the impact on the airline industry. And also, well, how much longer the war goes on and how long will it take after the war finishes before prices start to stabilize again, come back below 100 and maybe back to levels that we were seeing kind of in the previous 3 to 6 months. Bit of an unknown at that stage. So that's one thing that's certainly impacting from a UK economic perspective. The second thing that's impacting is, of course, there is a certain amount of instability when it comes to the political position in the UK right now. So we know that the Chancellor has been positioning for a while now the amount of fiscal headroom that's going on and where the UK is going to be in terms of 2030 and debt. So the UK debt, something I've talked about, government debt, has been running, and this is not a new news. So I always add, this isn't a current political situation. Government debt has been increasing year after year for quite a long time now with a massive spike. Obviously went through that COVID period with furlough as well. And the dilemma now is that the government is facing over 3 trillion of debt that has to be paid back. So this is where things start to really hurt them, where interest rates go up. And for example, it starts to cost the government more to service the debt that has to be paid. A couple of things playing out. One is that actually our productivity as a country is not rising as quickly as our debt is. So actually that makes it harder for us to pay that debt back. If we were producing more, that's more goods and services, the economy's growing, the tax take is then growing. It makes it easier to service the debt. Where that's not happening because the economy isn't growing fast enough to keep up with the debt, or the interest payments get higher because interest rates are rising, that puts more pressure on the government's ability to service that debt. And obviously, that's not a great place to be. And so what then happens is when the government goes to the market to say, okay, we'd like to borrow some money, please. We've got a, rotating over many years how the government manages its debt. And it goes to borrow that to the market to borrow more money, issuing gilts, government gilts or bonds. What happens is people see the risk attached to lending the government money as a greater risk. And what happens when people see a greater risk is, well, they're going to charge for that. So basically saying to the government, and the government issues basically IOUs with these gilts. And they're saying to the government, well, I accept this IOU, but actually I think the risk has gone up. I think you're finding it harder to service the debt. Actually, if interest rates go up more because of inflation, that cost to service that debt is going to go up even more. And people want a better return for lending the government money. Hence, to the right-hand side of the chart that's on the screen now, you can see how that yield, it's called, on a gilt has gone up significantly over the last 5 years. We're now facing a return on that gilt that's at a 30-year high. So basically, the government having to kind of offer to pay a much higher return to borrow that money than they were at any point over the last 30 years. That's not a great place when actually it's all about trying to service that debt at the lowest possible price. So two things causing that tension right now. One is the war, and the second is obviously our own political situation in the UK. So what's going to happen? Well, I guess over the next few weeks, we're going to see what plays out with the political situation. Why is it a nervousness at the moment? The markets are concerned that some of the names being mentioned for the potential leadership challenge, should there be one in the Labour Party, is there perhaps they call it a looser fiscal policy. Whereas at the moment, the markets believe there is a plan. The plan will work. There will be some shocks to the plan obviously happening, such as an unexpected war, but actually that there is a plan and that they believe the current Chancellor and Prime Minister are very focused on making sure that plan is delivered. Any change in the leadership might bring a different fiscal policy into play, and that might cause nervousness. And that's why the markets are slightly saying the nervousness is over. Actually, we need to charge more to lend the government money. So we know more about how that's playing out in the next few weeks. We'll see. We'll also know more, hopefully, about kind of what's settling in the Straits of Hormuz. Do we see an outcome to that? And therefore the ability to bring oil prices down. And then people say to me, Richard, what's happening though the markets? And I remember when Lindsay James joins us, she always says, look, markets are not economies, etc. Well, markets have been amazingly resilient on the whole over this time. We've seen some very strong performances, particularly around the technology sector in America, but still actually, in spite of all this noise, we're still seeing some very, very strong performances across some of the markets. So that's what we're seeing for now. We're going to know a lot more in the next couple of weeks. Obviously, try to give you a very quick potted background as to where we see ourselves. Look forward to coming back again in a few weeks' time just to give you another update. Until then, thanks for watching and bye for now.